As the U.S. markets are closed for the weekend, we can look at the final figures from this past Friday, November 7th, 2025. Strive Inc., trading under the ticker ASST, closed the session at $1.51 per share. That was a gain of 4.14% on the day. But that simple closing number tells absolutely none of the story. This stock traded in a wild range, opening at $1.38, dipping to $1.30, and then catching a massive bid into the close, all on staggering volume of over 158 million shares. To put that in perspective, its average volume is closer to 6 million. This is not normal activity. This is a clear sign of a major developing situation that is attracting intense speculation. The immediate hook here, the thing that's drawing in all this volume, is the massive gap between what people think Strive is and what it is actually becoming. The general market expectation is that this is simply the public face of Vivek Ramaswamy's asset management company, the firm known for its anti-ESG or shareholder primacy stance, which runs a number of ETFs. But the reality of the stock, ASST, is something entirely different and, frankly, infinitely more volatile. The company you are trading under the ticker ASST is the result of a recent merger with a small-cap tech company called Asset Entities, and it has been completely repositioned. As of just a few weeks ago, Strive Inc. is now on a formal mission to become the first publicly traded asset management Bitcoin Treasury company. This changes the entire investment thesis. You are no longer buying a simple asset manager that collects fees. You are buying a company that is now using its corporate balance sheet to accumulate Bitcoin, in a model that looks much more like a MicroStrategy than a traditional financial house. And they are not wasting any time. Just this past week, Strive announced an upsized initial public offering of a new variable rate Series A perpetual preferred stock, raising approximately $160 million in gross proceeds. The stated use of these proceeds? A significant portion is earmarked for corporate purposes, including the acquisition of more Bitcoin. This isn't a theoretical pivot. It's a funded, active strategy that is being executed right now. This is why the volume is exploding. The market is trying to decide if this company is a brilliant, leveraged way to play the crypto space or a high-risk gamble that has tied its fate to an external asset. Let's dig into the action. The common belief is that you're investing in the company that runs the ETFs, and that's part of it, but it's the subsidiary, Strive Asset Management, LLC. That arm is the one managing over $2 billion in assets. It runs funds like the Strive 500 ETF, which holds all the big names you'd expect. Its top holdings include NVIDIA stock, Apple stock, and Tesla stock. That part of the business is a stable, fee-generating operation. It provides a cash flow baseline. But the parent company, the ASST stock you buy on your Robinhood app or through your Fidelity brokerage account, is a different animal. The parent company's strategy is now to take its own corporate cash and buy Bitcoin. This creates a fascinating and very risky dual-pronged company. One part generates fees from passive-style products. The other part is making a very active, directional bet on a single asset. This is where the recent stock movement gets so interesting. The 52-week range for this stock is $0.33 to $13.42. That should tell you everything you need to know about its volatility. The stock was trading under $1 just a couple of weeks ago. This entire move to $1.51 is based on the market digesting this new Bitcoin-centric identity. The bears, and there are many, see a company with a history of negative operating margins and a questionable merger. The official short interest data from NASDAQ shows over 13 million shares are short, and off-exchange short volume ratios have been consistently high, often over 50%. This means for every buyer seeing a visionary Bitcoin play, there is a seller seeing a dilutive, high-risk venture. This is a classic battleground stock. The bull case, however, just got a major shot in the arm. Along with the $160 million preferred stock offering, a Form 4 filing hit the wire. Vivek Ramaswamy, a 10% owner and the public face of the brand, just purchased $1.25 million of this new preferred stock. This is a powerful signal. When an insider, especially the founder, puts their own personal capital into a new offering, it demonstrates a strong belief in the new strategy. This is not a token purchase. This is an alignment of interest that the bulls are clinging to. They are betting that Strive can use its asset management arm as a cash flow engine to fund the Bitcoin Treasury, creating a public company that offers leveraged exposure to crypto, but with a real business attached. This is far from the world of a set-it-and-forget-it platform like Schwab Intelligent Portfolios. This is active, high-stakes corporate management. The company's business model is this hybrid structure. The asset management subsidiary continues to compete with the giants, offering its specific post-ESG viewpoint. This is the part of the business that's about online investment and building a brand. They are trying to attract investment help seekers who are tired of the current consensus. This is a long-term brand-building exercise. The second part, the Bitcoin Treasury, is a much more immediate and aggressive financial strategy. The company is effectively telling the market that it believes Bitcoin is a superior treasury asset to cash. By doing this, ASST is attracting a completely new class of trader. The SoFi Invest user who is looking for a stock with crypto-like volatility is now watching ASST. The serious trader using interactive brokers is watching the Level 2 data to see how the short sellers are going to react to this new capital raise. It's a convergence of different investment worlds. Now, we have to talk about the risks because they are substantial. The primary risk is execution. The company is trying to do two very difficult things at once: build a major asset management firm from scratch and run a speculative treasury operation. The second and more immediate risk is dilution. Along with all this news, Strive also filed a prospectus for the resale of up to 1.28 billion shares of its Class A common stock by certain selling security holders. That's billion with a B. While the company won't get proceeds from this resale, it signals that a massive amount of stock could hit the market, potentially overwhelming any buying pressure. This is a huge overhang. The financials are also a concern. The company has a history of unprofitability. The data shows a negative net profit margin and a beta of 16.67%. A beta that high is almost unheard of. It means the stock is theoretically 16 times more volatile than the market. This is not an investment for a faint-of-heart, self-investing individual who wants to build a quiet retirement in an individual brokerage account. This is a trade. This brings us to the future outlook. There are two clear paths forward. Path 1 is the bull case. The $160 million raise, combined with cash flow from the asset management arm, is successfully used to acquire a significant Bitcoin position. If the price of Bitcoin continues to climb, ASST's balance sheet expands and the stock price moves with it, acting as a high beta proxy for the crypto asset. The asset management arm grows, the brand gets stronger, and the shorts are forced to cover, leading to a massive squeeze. Path 2 is the bear case. The price of Bitcoin stagnates or falls. The company burns through its new cash. The 1.28 billion share resale filing creates a constant downward pressure on the stock as early investors cash out. The company is forced to raise more capital, further diluting common shareholders, and the stock bleeds back down to its sub-dollar levels. The core tension is whether the stable fee-generating business can support the high-risk Treasury ambitions. This is a critical moment for the company, and I'm genuinely curious what